All right, welcome folks to Wook Capital Management's year in review, our final Wook in review of the year. We had a 1 week delay because the owner of Twitter was unhappy about reporters reporting on him, so he turned Spaces off last week, but we're back. Spaces are back. This is Rod Alsman. I'm the managing director at Wook Capital Management. I do want to just get a disclaimer out of the way before we get things going. Need folks to be made aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to the general public and do not provide investment advisory services. Solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from their professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay, with that mouthful out of the way, thanks folks for joining our last Wook in review of the year. As I mentioned, we had a 1 week delay, so I certainly don't expect it to be too busy in here today. For those of you who are in the Wook Capital Discord, anything that I screen share, I'll put up on screen live if you want to follow along in there. Otherwise, audio only should be sufficient for today in particular. Look, we had I think a pretty interesting. I mean, it's been a pretty crazy 2022, right? From a overall market perspective, there aren't too many years in which you see most every asset class take it on the chin pretty significantly. Some obviously more than others. So it's been a brutal year out there. We did include in the newsletter some commentary from John. I'm not sure if John's going to be joining in this week since we had to reschedule, but John did kind of share some thoughts that I'll kind of recap in the newsletter that we sent out last week. Look, this is new for us. We first started this adventure in effectively January. I first met John in person actually in January in Miami. As we were kind of building out our initial processes and starting to ideate and iterate Wook Capital. John and I had met digitally, of course, before then, but I think it's a testament to this new world we live in that you can come to an agreement to work for someone, leave a job that you really enjoyed without ever meeting them in person. And thankfully, it wasn't a scam, right? But John's managed the trading end of things for us year to date, and I don't have a final tally, and obviously we have a few more days left, but we should still be up in the low to mid teens year to date, depending on how the last few trading days of the year go, which, considering the one security that we publicized, PLBY, which we own a slightly less than 5% position in, and have obviously been vociferous about our dissatisfaction with how management's managing the business. While that's been a major detractor of performance, John has done a fantastic job sussing out trading opportunities throughout the year, kind of with a neutral to downward bias in the market, indices at least. And that's kind of paid off for us with the year-to-date performance that we experienced. So obviously the major indices on a year-to-date, I guess net of today, NASDAQ down 33, S&P just shy of 20. So, to eke out a teens gain, I think we're quite happy with where that settled in, considering the headwinds. Look, I think one of the big things that we are looking to do more of as we move into 2023 is to both conduct and disseminate and discuss kind of single security analyses more regularly. This is as I said, this is very much a learning for everyone on the Wook team. We started the year with it being 3 of us, and we ended the year with the team having grown to 5 of us. So that's always good. We've shared kind of. I'm going to go over some of the things we've done this year, talk a little bit about some of the things we hope to do next year, and we certainly hope that those of you who have take the time out of your day to complete the survey, the year-end survey that we have. I think Joe has it pinned in the nest here. Yeah, if you want to contribute any thoughts, feedback, etc., as we prepare for 2023, I would sincerely appreciate it. So yeah, I mean, look, again, Wook Capital, like what are we all about? Some of you have heard this ad nauseum, so I apologize again if this is maybe your first time listening to anything we've had to say. I think it's vitally important to recognize that our core investment thesis behind the fund is a view that we can realize investment alpha through trying to effectively scale this crowdsourcing of research that's been going on for years, but I think it's really come to the forefront in the last few years, especially as many people were forced to be stuck at home with nothing better than to become digital detectives and sleuths. But this idea that together we can achieve investment alpha through collaborating with retail investors, crowdsourcing equity research, uncovering overlooked information, and coming up with actionable insights. I think it's novel for a private investment fund, a private family office to seek to work with the investing public in this sort of a way, and obviously there's regulatory considerations we have to make sure that we're staying above board on. But to the extent that we're willing and able to, we want to be as transparent, as collaborative, as open as possible with sharing as we grow and build. And what have we done? So we've done a couple different forms of programming. Obviously, these Wook reviews are a weekly form of programming where we kind of take pulse of some of the major highlights that are going on in markets in any given week. Also, any particular topics that are salient in that week, and we'll recap a few of them. As we move through the chat this afternoon. We started off before I had the opportunity to bring Joe on board, and Joe's helped significantly from from managing all the bells and whistles and nuts and bolts of social media and recording and the like, because I am an 80-year-old man when it comes to that. So I am appreciative having Joe here to help as we've kind of honed and refined throughout the latter part of the year. But early in the year, we had a couple pieces of programming. The first thing we did was this kind of shareholder activism program. We called it the Wook End. It was our first social media programming of the year. It was in March. And if you recall, if you listened to it, if you didn't, what was it? We basically had someone who's currently an AGC at a publicly traded company. I won't dox the company, but Chris joined. Chris had actually been a friend of mine from high school. We ran track together, and I guess at this point, more than 2 years ago, in 2020, I had reached out to him knowing that he had worked in shareholder activism at Sidley at one point. And as GameStop, all the fun and games that came about with Cohen's campaign was ramping up, Chris had helped me to pen a letter. I ended up sending a letter to Ryan Cohen in December, basically many of the different retail investors I'd befriended, come to know, built relationship with over the several years leading up to 2020's mania. Well, 2021, Jan 21, right, is when it became a mania. But before it became that, there were some very serious investors. Myself and John's shares ended up being the bulk of the 4% of shares outstanding that I effectively reached out to a handful of people. We had 4% of GameStop between us, and we wrote a letter to Ryan Cohen and said, "Hey, you have our support." So that part of the story I don't think is super well known. He settled with the board a week or two after that letter was sent to him, so I assume it helped his cause. But the Wook End, the first programming we did was kind of to recap some of that, kind of walk through the long story of GameStop's activism and what happened to even set it up so that Cohen was positioned to be able to have the success he had in his campaign. We talked about the Bed Bath campaign a little bit. Obviously, that was going on at the time. We we didn't formally include the programming, but some, I think, really fun and interesting programming that I had an opportunity to host later on in the summer was I had an opportunity to have Jake Freeman of Freeman Capital Management, who had filed a 13G in BBBY in the summertime, and I had him on in late July, as well as in the first week of August, to just talk through the proposal he had made, which Jake, for those who don't recall, Jake was the 20-year-old who had effectively realized I think it was 110 or so million gain after he exited BBBY. But it was pretty great that I had the chance to speak with him in July, and this was before any of the crazy price movement occurred, but hear his thinking on the matter. And, it goes back to something we talked about in our Wook Book Club a couple weeks ago, the incredible importance of luck in investing and in life. And Jake was a beneficiary of being in the right place at the right time. He bought close to the bottom. He certainly was not well acquainted with social media and Reddit, but Bed Bath Beyond became eligible for inclusion on Wall Street Bets, and that balance of August ended up seeing Bed Bath Beyond, for a variety of reasons, become the next meme stock. So even though he had a fundamental thesis, he had a well-reasoned logic for why he thought there was a way to see the company solve some of its liquidity issues while also getting a win-win for bondholders and shareholders. He obviously didn't envision it becoming the next meme and going to $30 per share briefly. So obviously he successfully exited the position, and it was a great win for him, and awesome, to get that story out for him. It was great for me to get to know him and to get to host those calls. But I think it just shows you that crazy things can happen in markets, as I think I've said many a time. Whether under the Wook handle or in my personal handle, if there's anything we've learned about markets in the last couple years, is anything can happen in the short term, and there can be extraordinary disconnects from fair market value to either direction, up or down, and especially as there's just more and more sheer fund flows, money just flowing in and out of different equities that is very agnostic to the idiosyncratic nature of those equities. It's incredible. We've talked on here about the mix of 0 day to expiration option trading growing to now being 40% of the market. There's a reason that the folks on Wall Street Bets who call it a casino, that mentality is understandable why some folks would have that mentality. But I hope that with the programming that we're putting out and the conversations we're having, we're trying to draw a very clear distinction between what we're focused on, which is investing, which is finding businesses that generate or will in the future generate cash flows out in excess of what the valuation implies today, right? Finding a discount from what we think is an intrinsic value or a fair market value, not trying to chase the shiniest object and handing it off to somebody else in a greater fool game. That's the type of stuff you're looking for. There's plenty of Atlas Tradings and Zach Morrises of the world out there to rug you. Please don't look for us to be ever acting in that vein. As we've made clear, we're never going to be interested in taking a penny of yours for any sort of service. We're doing this out of that novel view that we can realize alpha by building relationships and networks of knowledge across the world, across different investor backgrounds. Folks who are formally trained in this stuff, folks who've never worked in finance a day in their lives. It doesn't matter, what background you have. I think there's something everyone has to offer, a unique perspective, some novel insight based on their lived experience, et cetera, to make us all better investors, more knowledgeable investors. And it's not trying to find someone who's exit liquidity for a pump. That's not what we are. So hopefully that's a little bit of philosophical waxing. Enough of that. So we did the shareholder activism weekend. We had a really fun. Our second weekend was actually we brought back the crew who ended up being behind the GMEDD initial report. A lot of the investors, many of whom have been private and opted to stay in the shadows and not be part of any of the documentaries, et cetera. But we basically brought the folks back together, the band back together, who got this idea churning in the first place. Again, for those who don't know, myself, Joe, and it was a dozen or so other investors who went out of our way, and we put this gmedd.com website together and published a research report and an Excel document and made all of that freely available, freely downloadable and modifiable. There was no paywall, there was no anything. We articulated our viewpoint. We published a viewpoint that net of all known information, net of Ryan Cohen's settlement with the board. We put this out January 20th, I think it was, Joe, 2021. And obviously within a few days, things went beyond our wildest dreams. So when I say our wildest dreams, the fact that being able to sell out of GME over $300 per share for me, I know for John as well, that was a very much a tail outcome. It was not the expectation. It was something that we knew was a possibility based on the underlying landscape that folks like Melvin Capital had created over the course of the second half of 2020. So that plus the Cohen plus just whatever happened in Jan 21, the mania moment, if you will, that led to that, that we wouldn't be here having this conversation today if that didn't happen. So you have to nod to things that go beyond our control, right? If you missed the conversation during that second book club we had, I shared, for me personally, I had sold most of my GameStop position in the first week of January 2021. Most of my options position I exited because I knew, for those who were following along back then, you remember I used to crowdsource all of the order numbers for their e-commerce operation. So I had a model that I was sharing on Twitter and StockTwits showing how their e-commerce performance was going. And I saw that the results were going to be disappointing. So I let the data inform my decision to take my call options off the table in the first week of January. The holiday sales report came out, and I was validated. The results were weak. However, I had no way of knowing that Ryan Cohen was going to have a settlement with the board that same day. And of course, the rest was history after that. So I gave up 500, not 500, sorry. I had about $5 million in Forsaken gains, and I still realized about two, but of Forsaken gains because I, was driven by the data, and again, it goes back to the luck thing, right? I was unlucky in not knowing there'd be a settlement, but you can only act on what you know. It goes back to, we had a good discussion of poker in that second Wookin review, that second Wook book club. You can have a pair of pocket aces and maybe somehow right, that you're going to get someone's going to turn a card or a river on you and you're going to lose. Well, you're still not going to fold a pair of pocket aces, pre-flop. If you have the best hand, you're gonna play it, right? And there's all sort. It's always difficult with investing to look back after the fact and know if there was a good decision, a bad decision, because just because a price moved in your direction, that doesn't mean you made the right decision one way or another. It could go against you, and maybe you made the right decision or wrong decision. So we had some of that conversation in the second book club, which we have the recording out. Joe, I don't know if you pinned that one, but I really enjoyed these book club conversations we're doing. So we've done two of these now. Our plan is to do them monthly, where we pick a book, we give folks 3-4 weeks to read the book. If you don't read the book, that's fine. You're welcome to join in and hopefully learn something from it. We talked about the most important thing, which was Howard Marks, the famed founder of Oaktree Capital, which is a distressed credit specialist. He's put out these memos for years and years, since I think the early 90s. So ironically, we held this call a couple weeks back, and he had released this sea change memo that same day. So we had a great conversation, and I think it hit on a lot of the things you need to think about when you're investing: risk, what is and what isn't risk. So there's some really good conversation about that. So we've done that. We're going to continue to do these book clubs. We haven't settled because I've been in vacation mode. We haven't settled on the January 2023 book yet, but expect something from us the first week of January. We'll get that out and we'll communicate that. If you're not signed up yet, the Wook Capital handle, there's a link to get signed up for the newsletter. That way you won't miss any of those communications. Also, the Discord server, again, it's just wook.gg if you want to join the Discord. So we've got that. We're going to begin to produce some more programming in 23 on different earnings calls. So obviously, most companies operate on a calendar year. So December 31st comes along in 8 days, and that will be the end of their fourth quarter. And then a few weeks after that, they'll begin to report their results for the quarter. So late January into throughout February, we'll get those companies operating on a calendar year, their earnings results. So our plan as we move into 23 is that we will be hosting the calls of certain companies live on Twitter Spaces. So we're looking to do a mix between your brand name mega cap companies that everyone knows, but also we want to make sure we're covering small and mid cap companies, because the reality is for you to have a differentiated viewpoint on Apple, Amazon, Meta, the likelihood that you're going to have some deep insight that the market doesn't, when there's thousands and thousands of analysts globally whose entire livelihood depends on them knowing everything about these securities, strikes us as unlikely. We certainly, that isn't to say don't invest in large or mega cap companies. It's just that your likelihood for outsized, returns is unlikely to be there, and to have variant perception that's truly differentiated is less likely to be there than with, say, a small or mid-size, mid-cap business where there's just simply fewer eyeballs on it. There's more of a likelihood for mispricing and misunderstanding. So we are working on getting all of that ready, but that's something that will be beginning in late January. The expectation is that it'll be a combination of broadcasting these calls live, and look, we're trying to target a pretty broad audience. So I understand, some folks listening in, you might already do this stuff and you might know all about this stuff, and if you work in the industry, then this is obvious to you. But for others, I know a lot of newer investors in the market, over the past few years in particular, who are trying to learn some of these habits that I think are essential to become a better investor and to think like an investor and less like a rabid speculator. We're going to kind of talk through, what are you listening for if you're listening to an earnings call? What are you looking to hear? What are these little nuggets that sometimes you get from these Q&A sessions? The analysts are asking questions that you'll occasionally garner incremental information that had not been shared before. Again, I use GameStop a lot just because it's very readily in my mind. But I think about, there was a 2019 earnings call where the company disclosed that 95% of its stores were four-wall EBITDA positive. Not the type of disclosure that is going to show up in a 10Q or a 10K. So sometimes these earnings calls can be valuable, where you'll get marginal, incremental, useful information to inform your view on a business. So we'll talk about, like, what is it that you should be listening for. So it'll be a little bit of, I think, hopefully an educational plus informative process. So we still are fleshing that out, but we'll have that coming along in 23. So what else did we do? We did a lot of the weekly Wook in reviews. So I mentioned we talked about a lot of different themes that were going on throughout the year. We didn't really start these up until really September. So our first one, ironically, was after the September Fed Open Market Committee. We talked about what was going on there. And it's interesting. I'm looking back at my notes. It's just wild when you look back, even just a few months, with hindsight, and you see these different trends that have continued and the like. Housing was obviously a big theme that we were talking about in September, and housing has continued to do poorly. Although there's been a little bit of a deceleration from a rate perspective. So rates are no longer north of 7%. 30-year average has come down somewhat, but still, if you're talking about a 6.5% 30-year fixed rate mortgage, again, it's just night and day from a year ago when you might have been looking at a 3.5% 12 months ago. So the impact of financing cost increases is something that's been present since our first one, and a hot topic that we've talked about a few times. We spent a lot of time in our fourth Wook review talking about autonomous driving. So that's something that in the ensuing weeks and months since we had hosted the call, there were several developments. When we hosted the call, the theme that I tried to convey was that driving assist is something that is coming very soon, is already here. It's going to continue to proliferate for some time, whereas true autonomous driving, while you have a couple players that are beginning to offer and are offering commercial services in a few markets, by and large, there's been a continued moving of the goalposts with AV as opposed to ADAS, Advanced Driver Assist. So we talked about ADAS being something that's going to continue to grow. Bloomberg put out some good research in the ensuing weeks, kind of in line with that view. And then a few weeks just after we had that conversation, Argo AI, Ford's arm, shut itself down. You saw TuSimple, the trucking computer vision AV provider, going through a lot of issues. So Tesla's, of course, seemingly on its ever ongoing federal investigations because of how it markets its quote unquote full self-driving level 2 plus ADAS system. But the trend seems to be that ADAS is going to continue to be present, proliferate. And by ADAS, we mean things like a level 1 system, for example, would have one point of control, whether it's latitudinal or longitudinal. So it could be adaptive cruise control from a longitudinal perspective. It could be lane keeping assist. If it has more than one, then it's a level 2 system. So your hands are still on the wheel, your eyes are still on the road. But these things, automatic emergency braking, isn't necessarily a form of autonomy, but it is. These things do reduce crashes, improve driver safety, etc. So these are very real technologies that exist today. I mean, I have a 2017 Chevy Volt that has level 2 autonomy. It's not new technology, but the proliferation and the penetration into new vehicles has risen and will continue to rise through into the 2030s. And then the question mark really becomes, when in the 2030s? And I think the reporting from Bloomberg's New Energy Finance just a couple weeks ago was still even into 2040. You're talking, maybe you're getting into double-digit % penetration of vehicles. So it goes back to just that autonomous driving continues to get pushed out, but assisted driving is here and growing. So we talked about that in the fourth Wook review, and I'm not going to recap all of the different ones we did. I wanted to, we talked about Musk. We've talked about Musk. It's hard to ignore him. But obviously Tesla's implosion of late has been an interesting story. I don't think we've not disclosed any positions in Tesla. I personally have talked about Tesla. I had thought it was an attractive short, and I'm kicking myself because I took most of my puts off way too early. So while I banked some nice realized gains, you always have that woulda, coulda, shoulda of. I have quite a few January call puts. I sold that if I were still holding on to them, they would have made my Christmas quite lovely indeed. But such is life. So we had all these different Wook reviews we talked about energy, security in the fifth one. I'm just looking back at some of the difference we talked about. An interesting one we talked about in the sixth Wook review was about active versus passive. And one of the interesting things for this year, I saw in the Wall Street Journal this week that active managers, and I don't know if this was just US large cap or what swathe of the universe it was, but that active managers relative to the passives have actually 55%, more than half, have outperformed the passive index this year, which is a huge change from the preceding 15 years. You've seen, I think the data point that we shared was that, I guess it depends. Like if you look at S&P, they have, what is it, SPIVA, S&P, I don't know what the acronym is, but S&P puts out good research on active fund managers versus passive. Yeah, SPIVA, I don't know what the acronym is, but whatever. They've been doing this for a long time. In the US, for example, over the last 15 years, this is through June 30th, 90%, 89.4, but I'm going to round it up to say 90% of all of large cap funds have underperformed the S&P 500. So not only are you going to pay that active manager a nice little fee for his or her services, but 9 out of 10 of them have underperformed over a 15-year duration versus just the S&P 500 index. So while that's changed this year, that now 55%, give or take, it seems, have outperformed the index, the S&P 500, at least if we're talking large caps. Historically, active has underperformed. I do think there's been a lot of discussion in investment media that it's a stock pickers market, right? So it'll be interesting to see in 2023 if active is able to continue that very recent trend of outperformance of passive. But it's just important to note how rare it has been in recent history for active management to outperform. And we talked about that in the sixth Wook review. We did draw the distinction, though, that specifically when you talk about like domestic United States or developed markets like Canada, that when you shift toward less developed markets, that success of passive versus active does dissipate somewhat. So when you think about markets, and I think it's intuitive if you think about, there's just so many more eyeballs maybe on the US market, that opportunities for alpha are less than in developing or frontier markets. And of course, then there's the risk of, what are you doing investing in a frontier market you don't have any unique insight into? And that's where maybe you need to do your research to find an active manager who has a track record, who aligns with your way of thinking and the like. But anyways, we talked about that in the seventh Wook review. We talked about the technology layoffs that have been ticking up rapidly in the seventh Wook review. Obviously, that has thus far been largely oriented in technology, and a lot of these companies that overhired because they extrapolated COVID trends, and many of us extrapolated COVID trends thinking they'd continue forever, and obviously they've not. So that's impacted a lot of technology companies. But by and large, when you look at the U.S. job market, as the chair Powell noted 2 weeks ago, it's still very much a demand imbalance. You've got a lot of job openings, whichever way you try to slice it. If you look at Indeed data, if you look at JOLTS, there's still a lot more job openings than there were prior to COVID. If you look at the Indeed data, it's still almost a 50% premium, so it's still a huge increase in workers demanded relative to the supply. If you look at JOLTS, it's still showing there's multiple job openings per unemployed individual, 1.x, insert X here. So those things are still where the Fed is looking to see the final evidence of inflation being defeated, if you will, is in those services, non-housing services area of the market, which is where that kind of worker is still seemingly in high demand. And that'll be interesting to monitor as the fourth quarter wraps up and the first quarter comes into vision, we've talked extensively in some of the working reviews about how earnings estimates appear to still be quite elevated relative to what the economy is looking like it'll be in 2023. The Fed, as we talked about, the Fed is saying in their summary of economic projections that for 2023 they expect, what is it, 0.5 or 0.7 of a percent for the gross domestic product growth rate year over year. So, GDP growth is basically flat, which is what they hope, right? They hope that they can successfully see this soft landing where growth doesn't go negative into a recession, and that inflation can cure itself, because if your view is that most of it was transitory, and now that we're finally seeing supply chains unclogging and prices whipsawing back down, whether it's asset prices. I think we did asset prices in the 12th Wook review. Yeah, we talked about used vehicles. We talked about housing. That a lot of these assets still need to come down, or appear like they will continue to come down meaningfully into 2023. So then you get these questions of how much does that impact people's willingness to spend if next thing they know, they look and they see that their house is worth 400,000 and not the 500,000. There's been a lot of great research throughout the Twitterverse and beyond of how much better off the balance sheet of homeowners looks now relative to pre-GFC, great financial crisis, and I would agree with that. Just when you look at the amount of home equity that exists, it's not like if prices come down 20%, you're going to have people underwater again, like you did for many years in 09, 10, 11, as that kind of got flushed through the system. There's a lot of home equity, and lenders have been vetted much more thoroughly in this era relative to pre-financial crisis. So, at least from a lens of does housing look like it's about to throw the economy into another great recession? It does not appear that way to me, but that doesn't mean that prices won't continue to drop and transaction volumes will continue to be light. And what impact does that have on consumer spending as it continues to flow through? And consumers will, in I guess January, February, look at their 401k statements for the year end, and as I mentioned, if they were mostly allocated to technology, they might be down 30%. If they were even in the S&P, it's almost 20%. So the psychic effects of the wealth effect, or the wealth destruction of seeing your investment assets and or your house, your car, whatever other financial asset you own, a real asset you own, that's going to be interesting to monitor, right? And we're seeing signs clearly that spending from a consumer side is looking softer. Like the early Christmas data points just a couple weeks back were like, single digit, depending on who you're asking. The raw increase in spending year over year looked like it was still up, albeit slightly, which when you consider that's a nominally reported number, that might mean that in real terms, spending was down year over year. It looks like the consumer is not, it's not like there's a late strength coming through as we come into Christmas. So definitely need to monitor how do retailers look as we come out of December into January. We had this conversation in one of the prior Wook reviews, I forget which one, about like inventory levels, and we talked about how certain retailers, like say a Target, seems to be more challenged than folks like, say, a Walmart. And there's, from the latest Walmart earnings call, for example, discussion of six-figure income households trading down to Walmart because they're feeling pinched. And even just this week, I saw the percent of Americans who live paycheck to paycheck, and it was like 47, I think, percent of households making over six figures. It was some astonishingly high number for what should be high income households that live paycheck to paycheck, and that had ticked up. So the consumer definitely, like, they've kept on spending, but the while they have strong balance sheet in some areas, it will be interesting as we move into 2023 to see how the consumer looks. But look, that's what we'll keep trying to do. We'll keep trying to capture the data we're seeing, share it, debate it, discuss it, and the like. So look, it's 4:45 almost. I had just kind of gone through some of the highlights of what we talked about this past year. If you missed it, again, I kind of set up why why we're doing these things. If you put a spectrum together of where we sit, we're definitely on the opposite end of folks like Atlas Trading. We're not interested in any of your money. We're not interested in. We're interested in learning together, really, more than anything, and that doesn't. It's not very exciting for someone who's trying to do a pump and dump scheme. But look, we've done these different forms of programming that I just kind of elaborated on. If there's different forms of programming that you'd like to see us do, we did the first short form video a few weeks back that Joe helped me put together, where we scoped out a retail location of PLBY's, their Honey Burdette brand. So, that's the sort of stuff that we'd love to understand what is most interesting to people. I think we know people want to hear and see more single security analysis than some of the more macro stuff. And we're going to be delivering that in 23. It's been a little bit about getting the right ducks in a row and getting ourselves structured to deliver that at a high level. But we expect to be doing that in line with kind of these earnings calls. I think you'll start to hear more single security analysis from us. As that earnings season gets underway, it's very logical for us to shift into more detailed discussion. So, okay, Joe, let me shut up. And I see you've been pinning a few things as I've been going along.
Yeah, I'd say in regards to the next year's content, if anyone does have suggestions, we do have that survey. It's at survey.wook.gg. So we put together this Google form. Just throw in your thoughts on like what content of Wook you currently appreciate and what you'd like to see more of. It takes like a minute. So obviously we appreciate any and all feedback. Try to create more value from the community. There's nothing nefarious. Just tell us how you think and what you want to see more of, and we'll try to do it.
Yeah, exactly. So, I mean, I like the book clubs. If you have any ideas for different investment books, if there's any, maybe less of like a formal book club, and if it's more like let's have a structured hour to talk about how I might look at a cash flow statement or income statement. We haven't done that sort of stuff yet because I think there's already so much great content out there. So maybe if that's something people are interested in, maybe we can do some compilations and make some of that stuff easily accessible, and give our own takes and riffs on it. Again, if you're watching this video broadcast, and my background here, my office has been turned into the gift room as we're getting our last minute wrapping underway for Christmas. But look, we're very appreciative that in a very short period of time, we've gotten to make some great relationships, as Wook Capital Management. But we're certainly not expecting. Look, as we've made very clear, investing is a very long duration thing. We think that we're going to be around for a very long time. We hope to be, and we hope that this can be a journey that we participate on, this whole investment journey. We can be another arrow in your quiver, if you will, another resource to tap into. And if you have insights to share, we'd love to hear them. So, it's still, again, I think, a very novel approach. We believe that crowdsourcing research from retail investors can realize investment alpha. It's not something that only the big boys on Wall Street can realize alpha, and you don't need to pay us anything to be a part of our network. We certainly will never be charging for any sort of services. Now, you need to do your own due diligence. Just because we talk about something doesn't mean it's a good investment for you. That's obviously not our purpose whenever we're talking about any security. We're just trying to better understand it, and yeah, I think we can do that better together. So yeah, that's kind of it. I kind of recapped a lot of what we did this year and some of the different topics we covered. Hopefully, gave you a flavor for what we're looking to do into 2023 and beyond. I mean, the emphasis is on beyond because we're all quite young. I'm the oldest one on the team, and I'm 33 to give you context. So, uh, I've noted before most of my investments are in my Roth IRA, which I can't touch for 26 years, 25 years, whatever the number is. So I'll be investing for a very long time, forcibly, whether I like it or not. But we again, we appreciate the feedback. If you take the survey, if you have anything to say, look, if you think that these are asinine and not useful, then that's your feedback, and you're entitled to it. If you'd like to see us doing more of something else, please let us know. I think we understand the stuff that most folks want to see already, but if you tell it to us again, it does not hurt. What else, Joe?
No, I mean, I just want to wish everyone a Merry Christmas. I mean, it's Christmas Eve today. Obviously, people are wrapping up presents, like you said you are. I've got a ton of presents under the tree. Rod, are you a present under the tree before Christmas or Christmas morning kind of guy?
Oh, they should be there. If they're wrapped, they should be there.
All right, that's where I'm at. Abby wasn't too happy with that. She was saying, Santa needs to bring them Christmas morning, and it's not fair that she has to look at them for a month. But
Yeah, my parents were that way.
yeah, so that's I got them all under the tree. She doesn't have a single one of hers under the tree, so I have no clue, how we're facing up here.
Yeah, I was out doing some last minute things today. I hopefully won't have to do any more of that, but doing my duties. But yes, we certainly, whether you're, look, I'm not, I'm an agnostic, but I still, as an American, love the secular holiday that is Christmas. Whatever your holiday du jour is, we certainly wish you a happy holidays. Um, and yeah, look, I'm going to cut it short there. I hope folks enjoyed hearing part of this conversation. Those of you that tuned in, we will continue the conversation in 2023 when we come back. But thanks everybody for being interested in Wook Capital and tuning in. And with that, cheers. Have a lovely holidays, and we'll talk to you in January.